All right, good morning, everyone, and welcome to MacroAce with your host, Tony. I am also the head financial analyst at FinancialJuice. We've got about 30 minutes until we get the rate decision. Forecast is for a 25 base point hike to 4.5% from the current 4.25%, widely expected to be a 25 base point hike. But we've got to go through what it is and what is the sentiment surrounding it at the moment. So don't forget to share the video with your fellow traders and friends if you found these live streams useful in the past. Now, what is the Bank of England bank rate? So it's a rate that the bank pays interest to commercial banks. And why is it important? So high rates, of course, equals a slowdown of growth, or to make sure it doesn't get too out of hand, also to try and control inflation, which is the current issue that the Bank of England faces with a 10.1% CPI figure, or the headline inflation in the UK. Low rates is there to support growth, or create growth, and also to drive up prices as well if there is a sign of deflation within the economy, or if there is a strong amount of disinflation that the Bank of England doesn't want to happen. So then, of course, with the bank rates, it affects banks handing out loans, mortgages, credit, etc., not just to to consumers, but also to businesses too. So if that also increases, then that makes it more difficult for those businesses or consumers to take out a loan for whatever their purpose is, and particularly for consumers with mortgages. As mortgage rates rise, it makes it more difficult for them to pay back that mortgage rate if they don't have a fixed rate, if they have a flexible rate. So where is the economy at the moment? This is also quite key to understand. What is the Bank of England seeing within the UK economy? What is going to factor into their rate decision today? So the unemployment rate is at 3.8% compared to 3.7%. Employment change was decent. It was 169k versus the prior of 65k. Inflation rate, as said, stuck in the double-digit range of double-digit figures of 10.1%. compared to the prior of 10.4%. Average weekly earnings year on year, again, another sticking point for the Bank of England with the potential for wage price spiral at 5.9%, which is unchanged. Good morning. Good morrow, Tim. Excellent. Good morrow to you, too. The GDP data that we had, Q4 of 0.1% versus Q3 of minus 0.3%. And the GDP year on year of 0.6% compared to the prior of 0.4%. S&P Services PMI was at 55.9 compared to the prior 52.9. And the manufacturing sector at 47.8 compared to 47.9. So remember, a figure above 50 shows expansion, below shows contraction. So the services side is performing better than the manufacturing side. But remember, most of the UK's economy is based on providing services. So, but although yes, the manufacturing side is quite a key figure to be aware of too. So usually when you go to 47.1 or below, according to economists, that's when that area is shown to be in heavy contraction and is seeing recessionary effects taking place. And retail sales, again, a key backstone of what are consumers doing. For their, what is consumer spending like? Is it getting stronger or weaker? Retail sales year on year minus 3.1% compared to minus 3.5%. Hello, Pataliano. You are a consistent viewer. Thank you very much for joining again. Adam Waters says, good morning. Would a 25 base point rate rise be positive or negative to the market? So that's what we'll talk about in a little bit. I'll kind of get through some of the basic prep here. Now, the previous Bank of England rate statement and rate, of course, so the Q2 CPI, they said there's likely to be lower than forecast in February due to longer energy price cap and lower wholesale prices. And then further tightening monetary policy would be necessary if there were to be signs of more persistent pressures, which is very obvious at the moment, of what we can see with double-digit inflation, particularly in the food side of the food prices that we're seeing from what we saw from the last CPI print, that being, I think it was at 19% within the CPI report itself, which is quite high. The last report before that, I think, was about 18% within the report. So those sort of figures, of course, mainly due to the supermarkets raising prices because of the fear of the continued supply chain issues that they face, higher, and also because to make the goods, provide the goods, to be delivered to the supermarkets has also gone up in price as well. So that is not surprising, but it is something that maybe that government could do something to try and stop supermarkets from raising prices too high. Maybe try to control the price level somewhat. But the Bank of England can only do so much within their role to try and contain price pressures within money flow. But it's down to the government too to see what else they can do to try and help bring down inflation. Bank of England decision maker panel says businesses see year-ahead inflation of 5.6% in the 3 months to February versus 6.2%. Members flagged that global growth was likely to be higher than it had expected in February. And then Bailey and other member comments as well. You had Bailey said that additional tightening is required if inflation continues, but he's not advocating a change in the 2% inflation target. So if you have sticky inflation and we're in double digits, maybe the one idea or argument is that you could make the inflation target higher and not so restrictive to 2%. So reaching the goal is easier rather than having to be too aggressive with monetary policy tightening. But on the flip side, if you do decide to change the 2% inflation target, which all the other central banks are looking at, or in the case of Australia, it's 2 to 3%, then you're maybe not doing as an effective job as other central banks are doing to bring down inflation. But like I said, there are other factors that the Bank of England doesn't have control of to bring down inflation that the government can jump into to help with. Patio Leonio says, loyal to making money. Adam Water says, first time on this channel, great information. Thank you very much. Don't forget to get the word out there, share with your fellow traders and friends if you find this information useful. March 29th, the Bank of England said that UK businesses are resilient to higher debt costs and less households are facing stress than thought in December. Pill said UK inflation may dip below 2% in 2 years. And government views, a very short thing, 1 point. Hunt said the current Chancellor said that CPI figures reaffirm exactly why we must continue with our efforts to drive down inflation, although there haven't been any measures taken by the government as of yet to try and help bring down inflation within the UK. And core inflation will be hard to bring down. So this is one thing that I'd seen. I was just reading through in the morning, a bit more of prep. So Al Arian, he was talking about how the government can do more to help the Bank of England. And one of the kind of things that could be done is that you could raise taxes on businesses. But then, of course, if you raise taxes and the rate is already high within UK, then it puts off businesses from producing more. There isn't enough productivity out there. So again, that's also another problem with UK. If we're at more or less flat with our GDP data, that's also another factor that the Bank of England doesn't want to affect, and neither does the government wants to try to bolster the economy, but without having to make the Bank of England's job even harder further down the line. So there's quite a thin line, and I've said this before with other central banks too in the past. But the UK in particular has a three-pronged issue of Brexit, supply chain issues with Russia-Ukraine war, and of course with inflation being stuck in the double digits. So the previous sentiment then from the Bank of England members of what we had seen in the last, prior to the last rate decision. So you can see here that Tenrera and Dhingra are the most dovish members out of everyone else, Tenrera being the leading member of the dovish side. And then what I want to show you is the flip, or not a flip, but a need to tighten more. So this is quite interesting that considering where inflation is at the moment in the UK, although inflation is still in double digits and it's at 10.1% compared to 10.4%, Tenrera and Dingra cite that there maybe, particularly Dingra, is saying that the rate is quite high, and that could have a damaging effect to the UK economy, and that's why they've been voting for no change in the previous rate decisions that we've seen in the past. And again, so if we think about it, so you can see here they had from the meeting of the 15th of December, Dingra and Tenrera have consistently been the ones to vote for no change. So that's going to be an interesting factor of as do we have another member such as Cunliffe who has dissented in the past looking for a smaller rate hike? Does he go in line with the Dove side, or does he kind of stick with what the rest of the central bank members are looking to do in order to raise rates by 25 basis points? You may have Mann and Haskell that may think that maybe they could do more with the bank rate if inflation is still in double digits, but we haven't seen that in the past with the Bank of England rate decision. So that's one key thing to remember is the difference here. So if I go back, there's more of a lean towards tightening rates rather than easing from what we've seen so far. Sorry, just having a look at the image. Okay, just a slight little difference. Okay, investment bank and market views. So, of course, this will be the highest rate that the Bank of England would have set their interest rate at since 2008, or 4.5%. So that in itself is quite significant as well, of how far the Bank of England have come and how much work has been done, but how much more work may be needed as well. So that's one factor to consider, that more rate hikes may be needed. April 10th, we had an expectation, a near 40 base point rise in interest rate forecast reflected repricing following stronger than expected CPI and wage data. April 19th, Morgan Stanley expects the Bank of England to deliver a 25 base point hike in May versus no hike expected earlier. Deutsche Bank sees 2 more rate hikes from the Bank of England to a terminal rate of 4.75% in June. So looking for another 25 after this rate decision. UBS, they expect 1 more 25 hike in May from the Bank of England, lifting the bank rate to 4.5%. HSBC sees 2 more 25s from the Bank of England in the months ahead. Goldman Sachs raised their forecast for the bank rate to peak at 5%. So looking for an extra 50 basis points worth of hikes, including this one as well, right? So 25 and then another 50 worth of hikes. So next, the couple of meetings after this one, they're looking for 225s, or they might be looking for 150 if the Bank of England decides to flip the switch and say, hey, let's try and bring down inflation as quickly as we can. If the government isn't going to support us, we might as well just crush the economy, crush demand, and then that hopefully they'll bring inflation back down. But I don't see that as a likely case, because you have the 2 members that are kind of citing the risks of a damaging effect from the already high rates in the UK. HSBC and Citi have been telling clients that the scale of tightening is already baked into the money markets, and we've seen that with the pound and how it's been performing in the recent month or so. Particularly when we're talking about why has cable been moving towards the downside today by quite a bit. Well, there's a risk trade that the Bank of England might not be that hawkish in their monetary policy statement in wanting to tackle inflation. So that's one thing to be aware of as to why we've already seen traders selling the pound before the rate decision is done, because there is that fear that has creeped in, as what some analysts have been citing. But if they do decide to flip towards the more hawkish side, then of course traders have a more favorable position to start buying back in to sterling if they talk about hiking past the June meeting, which they haven't really provided clear guidance like the other, like the ECB has in the past. Of course, they don't do that now. They haven't done that. But that's one thing to be aware of, is that there is a setup that's already taking place in case the Bank of England isn't as hawkish as they expect. So traders on May 11th, they expect another 25 basis point hikes by September. So again, looking for the Bank of England to continue raising rates for longer than they had expected, or longer than they expect. Market pricing, March 23rd, traders added to BV rate hike bets, pricing for support 62%. Of course, this is, remember, you've got the turmoil that has taken place during the month of March with not only SVB but Credit Suisse, and then that having an effect, or having a wider effect on the markets as a whole. So you had the repricing of where the rate or the terminal rate would be for not just the UK, the ECB, and also the Fed as well. 24th, traders no longer fully priced in another 25 basis point rate hike. How wrong they were. April 17th, Bank of England to raise rates by 25 basis points to forcible 5 on May 11th, according to 33 of 61 economists. 28 said that they would pause. So that's one thing as a risk factor just to be aware of. If there are economists that are looking at a pause rather than a 25 basis point hike. Traders raised bets on peak Bank of England rate by 14 basis points to 5% after the CPI data. That's not surprising. 5% peak Bank of England rate fully priced in the first time since April 21st to May 2nd, was what we had seen according to sources. So if there is the expectation for the rate to go to 5%, like Goldman Sachs had looked at earlier, then anything below that expectation, or anything that doesn't meet that expectation within the statement, okay, or if they do decide to go for a pause at this meeting, would be detrimental to the pound. So not only do we get, well, of course, the rate statement is important. The rate is important itself, but the statement is, and the meeting minutes are going to have a bigger impact depending on how hawkish or dovish the statement is, along with the meeting minutes. So now let's look at the prior reaction to the UK interest rate decision, and you can see it wasn't a very clear off the bat reaction from the markets. So this is about 10 seconds before the release that we'd seen last time around. So you can see that the vote comes in as expected for the Bank of England, for vote unchanged, vote hike, and vote cut. So the figure comes out, and then you see there isn't really a clear, there is a little bit of a downside move on the pound initially, but then it quickly turns around and goes the opposite way. So we see the pound accelerating in strength and seeing some strength rather than that initial bit of a dip. Now, again, that's because traders are sifting through what the rate statement has said. So if I just bring up the last rate statement, if I kind of skip ahead, just kind of see what we have. Ooh. So yeah, the reaction doesn't really last that long initially. So the reason, the sentiment surrounding the rate decision last time around was that the Bank of England said the banking system is well placed to support the UK economy, including period of high interest rates. And there was nothing that was nothing that was surprising from the statement. So there's more of a positive expectation provided from the Bank of England that gave it a bit of a rally. And then, of course, there wasn't anything new that was provided by the statement that led to a continuation of that rally. So, if we look at the deviations, if I just kind of bring it up here for you, let's bring this out. Okay, Let me close this video here and I'll bring up the deviations. So deviations are just showing you how much the markets have reacted to the interest rate decision or to certain economic releases. So you can see here, the currency pairs to look out for are on the GBP New Zealand dollar and GBP Aussie dollar. I have seen the biggest market reactions in the past. Okay, it was GBP CAD, but again, if we kind of go, let's scroll back to the date. We go 2nd of February. It was GBP CAD that had seen the biggest market reaction alongside GBP JPY, but that hasn't been the case in the last rate decisions. And the last rate decision that we'd seen, actually, because there wasn't anything new or outstanding from the rate decision, you didn't really see that huge of a reaction as to what we had seen in the past. Prior to from February 2nd, prior to that. So as said, the biggest market reaction was on GBP New Zealand dollar and the Aussie dollar. FTSE 100 was down by 27 ticks, and after about 10 minutes of trading, right, it was going in the same direction, but it kind of clawed back some of its initial loss, and it was down by 18 ticks. And then the gilts, or the long gilt for the 9 to 10 year, is down 23 ticks, and after about 10 minutes of trading, it was still down by 9 ticks, but again clawed back most of its loss. So what are we expecting today? What should we expect? If the Bank of England isn't as hawkish as maybe markets are looking at them to be, of maybe looking to continue hiking past the next meeting, and but they say that inflation is still quite high, so they may need to do a little bit more work. That could mean that the pound sees a bit of a depreciation. Second of all, that's if the rate comes in as expected, right? If there isn't, if the figure itself is as expected, what traders have already priced in. So then it's, as I said, to the statement and meeting minutes that you're looking to. So if the Bank of England is less hawkish than expected, with their expectation where they expect the rate to go, or maybe talk about where they see inflation, maybe not inflation, because they wouldn't really say that it's coming down nicely, or it's moderating. But so that's what could cause the pound to see a move towards the downside. The flip side to that scenario is if they do say that there is a need to continue raising rates, okay, but they don't give a specific time frame of how long that will be. That could provide some positive sentiment to the pound. But let's say if there is expected, where they're expected to go to 5% as the peak policy rate, if they mention that they want to continue hiking past September, okay, then that could be another positive for the pound. The other positives would be if they give a positive outlook to the UK's economy, that it's although GDP is flat, it is expected to continue to grow in the coming quarters, or in the rest of 2023. So that's also another thing to be aware of as well. And then the downside would be if they said that the effects of Brexit, if they do bring that up again, if the effects of the supply chain issues and GDP being weak are going to be worse than expected, and they start leaning towards a dovish side like Dingra and Tin Railroad do, that could be detrimental to the pound. If we get let's say if we get a 50 basis point hike, so you can see here there are a lot of factors that come through with a rate decision. Let's say they do go for a 50 basis point hike and surprise the markets, which markets are not expecting today, okay, at all, more or less not at all. Then they'll be very positive for the pound. If they if they go for no change and they decide to not raise rates at this meeting, then you'd expect the pound to plunge. Of course, there's a fight against inflation, and the Bank of England, for some reason, have decided to pause since something's gone wrong within the economy. Maybe productivity is going to see. Maybe there's a high chance of a recession within the UK economy that the Bank of England is seeing that everyone else might not be seeing. The other things that we should be aware of is that the vote as well is going to be quite key to keep in mind. So the voters. So if we get, let's say, everyone votes for a vote hike rather than the 72, then that could provide some positive upside to the pound. If every member of the Bank of England says, yeah, we need to continue hiking. The flip side is if we get more voters who are looking for no change, that could provide a downside movement. So if Cunliffe joins Dingra and Tenrera saying, yeah, we need to keep the rate unchanged where it is, we're at the 2008 peak, or we will be at the 2008. We don't want to get to the 2008 peak and stick at forcible to 5% rather than go to forcible 5%. That could provide some downside movement to the pound as well. So a mix of different factors that we have. We have about 4 minutes to the economic release, so I'll be keeping an eye on. So we've got GP New Zealand dollar, cable, and Euro GBP that we're keeping our eyes out open for. As said, these two have seen the GP New Zealand dollar and the GP Aussie dollar have seen the biggest market reaction. Actually, it was the GP Aussie dollar by a point higher than the New Zealand dollar. Had the stronger reaction, so I'll keep that up there. Actually, let's get GBP NZD down here. Okay, let's get TICKSTRIKE running as well. Okay, let's get our setup running. Okay, let's get this. Yeah. Cable. So first thing, of course, when we expect the rate to come out, then we've got to keep our eyes peeled on what the rate statement says as well. Ooh, let's see. Guys, so don't forget to like the video, share it, subscribe to the channel, get the word out there if you found the information useful. I hope you guys have found the information useful with what I've provided you here. As I said, there is a lot to kind of weed through when you're looking at a rate decision. All right. Okay, Sunak is talking now, saying goal is to halve inflation and we need discipline and focus. UK not on a glide path to halve inflation. That's Sunak spokesman Blaine speaking there. Oh, we've got a load of text headlines, text to expect first from the Bank of England. Patioliano says always, Tony, useful. Casadaga says I just traded what's on the chart. Fair enough. All right, let's see what this baby brings us, huh? Got about 15 seconds from now. Okay, 10 seconds. Okay, hike, 25 basis point hike, 25 basis point hike as expected. The vote for unchanged at 2 as expected. Vote hike at 7 as expected, and a vote cut 0 as expected. So data in line with expectation, seeing upside movement onto the pound. UK economy is seen growing by 0.75% in 2024, previously seen at 0.25% contraction, so a much better picture painted there. So BV delivers biggest upward revision to GDP in the MPC's history. So much better than expectation for the UK economy. Expect the UK economy to avoid a recession as well. So there you go. That's what we have there. What else do we have from the Bank of England? So it's going to go here. So inflation is to fall back more slowly than in February, and GDP to be 2.5% higher in 3 years than in February. So a more hawkish than expected Bank of England there. There's just a couple of things to notice with the rate statement as well, that they're worried on inflation for food and core good prices. So what I was talking about earlier, food prices in the last CPI report was at 19%. What are made up of the report. Okay, so that should conclude the reaction or the preparation for the Bank of England rates decision. Again, so the key point there: Bank of England delivers biggest upward revision to GDP in MPC's history. Thank you very much for joining me live. I will catch you guys next week. So don't forget for MacroAce, I'll put out a link for you here to subscribe here to get the upcoming live streams and deviations for the economic releases all in one place. There you go. That is it there. But for now, I have got to go.